Hi friends, Dixon Technologies, EMS Technologies, PG Electroplast, Umber Enterprises, Avalon Technologies. What's common in these companies or stocks? There are three common points. Point number one is that majority of these companies are trading at very high PE multiples. Some of them are trading at 100 PE multiples. Some of them are trading at 200 and so on. Second common thing is that these companies are under EMS sector, Electronics Manufacturing and Services sector. And as per a report by Motilal Oswal Financial Services, this sector is going to hit almost $72.2 billion US by FY27. This is going to grow at a CAGR of around 32% year on year. So basically these companies are operating in a very high growth sector. I'll speak about that in a minute. And the third common theme you will notice in the EMS stocks is that between September 2023 and September 2024, these companies have made investors richer. For example, Dixon Technologies have made investors richer by almost 180% between September 2023 and September 2024. Another example, EMS Technologies has made investors richer by almost 157% between September 2023 and September 2024. So EMS stocks right now are at a very interesting juncture because at one hand, the growth rate is huge. And again, I'll present you some data individually at stock levels. But at the same time, the valuations are exorbitant. And the key question is that this conundrum between growth and valuations, I'm trying to simplify this using the three stocks as an examples. This is going to be a huge learning for all my viewers. And if you don't know me, my name is Rahul Jain. I'm a full-time investor and a full-time content creator. With that, let's get this video started. So the first company that we would like to discuss is Dixon Technologies. Have a look at my screen and you will see the P&L statement of Dixon Technologies. There are two very important signals or patterns is what we need to speak about. First one is that have a look at their sales growth. So you will note that before March 2020, so before the COVID period, their sales used to be very flat. And you can see that getting reflected in the stock prices as well. So for example, if I show you their stock prices prior to April 20, you will note that the stock prices were moving flat because the sales were flat, fundamentals were flat. But what happened after COVID is what you need to note. The sales started to grow up at a higher speed. So as you can see, 2021, 2022, the sales started to grow up. So the stock prices also started to move up as the fundamentals were improving. But what you will also note is that after March 2023, the sales started to go up even at a very high speed. So from 12,000 crore to 17,000 crore by March 2024, and in trailing 12 month, it went up to like 27,000 crore. What happened as a result of that? If you see the stock prices from August 2023 up to June 2024, you can see here the stock also started to move up in terms of the prices. So why the sales have gone up, I am going to decode that because that will bring you a lot of learnings about the EMS sector as a whole. You need to really understand that point. But the second important pattern you will note from here is that although the net profits have also gone up after COVID. So see, from 2020 onwards, the net profit have gone up. Recently, the net profits have gone up from 2,055 crore in March 2023 to almost 750 crores in the trailing 12 month. So the growth has been very good. But if you see the net profit margin, so if you calculate the net profit margin, which is net profit divided by sale, this net profit is not even 10%. It's not even 5%. So this is a very low net profit margin business. And I need to explain to you why that is the case. And if that represents risks is what we need to understand. So why the sales of Dixon Technologies are growing at a crazy rate. So have a look at my screen. You will see that in H1 FY25, their mobile and EMS divisions sales growth has been around 217%. In fact, if I speak about the contribution of mobile and EMS division in the overall company's revenue, you will note that it used to be 56% in H1 of FY24. It has gone up to 81% in H1 FY25, meaning mobile and EMS division is driving 81% of the growth contribution of Dixon Technologies. And more importantly, it is growing at more than 200% year-on-year growth in terms of the sales number. Now you may have a natural question that Rahul, all of a sudden, how come their mobile sales are going up like anything? For this, let me now introduce the sectoral tailwind that this company is enjoying right now. What you see on my screen is Make in India goal. So Indian government had set a target of 300 billion electronics manufacturing by 2026. This is a huge target, and how will a government achieve this sort of a target? So in 2019-2020, Indian government announced production linked incentives PLI scheme for the electronic sector, and as per that scheme, Indian government was giving incentives for companies to produce more and more electronics, for example mobile phones, for example IT hardware, laptops and things like that. And if you see this data, you will note that every year almost 8,000 to 10,000 crores of production linked incentives have been given to the companies. So overall in the last 5 years, 40,000 crores of money was provisioned for the PLI scheme. That is why not just Dixon Technologies, there are a lot of other companies, and I'll speak about one of them, who have been really drawing on this PLI in the last 5 years. And the reason I'm explaining to you all this is because please understand, this PLI incentive is extremely important for these companies to have a dent on their profits. The moment PLI stops, there is a big risk for the companies like that. But very recently, I think just few days back, Indian government announced another 25,000 crores of PLI for electronic sector. Albeit the industry was expecting it to be another 40,000 crore, but Indian government announced 25,000 crores of PLI for the electronic sector. I think it will get formalized in the upcoming budget as well. I'm not sure, but let's see how the announcements come out in the budget. But the point here is very simple, that the sector is enjoying tailwinds that is driven by Indian government policy. Once you understand this, you know where to track the data, where to look at the risk in terms of the Dixon Technologies per se. This company is driving the sales mainly on the back of mobile business. And just to give you some data, in Q2 of FY25, Dixon Technologies actually claimed for 70 odd crores of PLI from government. And now let me bring you back into the profitability of this company, because if this 70 crore was not given by the government, the company will struggle to make profit. Let me again give you some data points on that. So what you see on my screen is H1 FY24-25 PET margin. So if you look at the profit after tax margin percentage, it is only 2.1%. So if this company is earning 100 rupees, only 2.1 rupees is what it is taking as net profit margin. This is extremely low. We all know that in the electronics business, the margins are really low. Competition intensity is very high, but 2.1% adjusted margin. And just imagine if the PLI was not adjusted in this, in fact, the company would struggle to make profit. So the PLI is extremely important, not just for Dixon Technologies. I will also explain to you some other companies in the same video if time permits. But the point is very simple. These are very low margin companies right now in terms of the mobile manufacturing or white goods and so on. Therefore, we need to acknowledge that as a risk here. So our question is, why such a low profit margin? Have a look at my screen. You will see that the cost of material that they consume to manufacture, for example, mobile, it is extremely high. 92% of the revenues is actually going into cost of materials that is used to manufacture various products such as mobiles. And this is because to manufacture a phone, the company might need more than 30 plus components. And Dixon is not manufacturing all these components in-house, and they know it. That is where their game plan is. Their game plan is very simple. They also now want to get into component manufacturing business. That's what their company is saying. In the next 18 months, they are going to get into the component side of the business. They are going to get that business also operationalized. Why are they doing it? Because they are going to reduce the cost of materials consumed. For example, here the company is saying is that by getting into the component business, almost 27% of the BOM, it is not BOM here, it is bill of material. So the individual components. So 27% of bill of material or the raw materials they are going to do in-house. That is where the efficiency is likely to be. And once they do it, that is where their profit margins are likely to improve. But it is not so easy. It is not overnight job. It is going to take minimum 18 months is what the company is saying. It might get delayed. So it is a long-term game here. Please understand this, that companies like these where you are looking to see profit margins going up, that is not going to happen overnight. It is going to take a lot of time. My last point on Dixon Technologies, it's all about high growth, massive growth, because the mobile production is going to continue to go up in my view, and the tailwinds are there. Government has approved 25,000 crore of PLI for the sector. But the question is that this high growth in the sector or by Dixon Technologies in the mobile manufacturing Is it sustainable from a valuations perspective? The valuations are exorbitantly high, and this is the conundrum between growth and valuations. And we as an investors might have very different opinion about companies like Dixon Technologies. Let me know what is your view on Dixon Technologies in the comments. Would love to read your comments, but please understand the PE ratio of this company used to be around 40. After the massive growth in sales that we have seen post COVID, the PE ratio is now at almost 200. I don't know when you're watching this video, but it has almost touched 200 PE multiple. The key question remains high growth versus valuation. There are investors who are happy to pay high valuations because of high growth that they see. There are investors that they say, no, high valuations are totally no. Therefore, investors might disagree from each other. Let me know in the comments what is your take while I move to the next stock. And before I move to the next stock, if you found this insightful, hit the like button. Let me know in the comments a simple thank you. It motivates me to come up with such content for you at zero cost. Also, you can consider joining my YouTube member community because almost on daily basis, I bring lot of insights, lot of exclusive content only for members. You are going to gain a lot of knowledge and you're going to become a better investor in a long term. The feedback of this community has been excellent. Simply go to my channel, press on the join button or go to the link in the pinned comment or description and join my community. With that, let's move to company number 2 that we want to nail down in the EMS sector. The second company that I want to discuss is KNS Technologies. A lot of comments came on my channel saying, Rahul, can you speak about KNS Technologies? So here we are. First thing we are going to have a look at is their P&L statement, profit and loss account. And you will very quickly note between September 2023 and September 2024, if you see the sales have gone up from 292 crores to almost 433 crores. So 1.5 times growth in just 12 months. I think it is very good growth rate in my view. But this is not what we saw in Dixon Technologies. Dixon Technologies went crazy in terms of the sales data. Here is a decent growth. And also if you look at the net profit margin, yes, they went up from 25 crore to 63 crore. But again, I don't think this is such a scale that we saw in Dixon Technologies. However, if you look at the stock prices between September 2023 and September 2024, investors got richer by almost 157%. So the reason I am sharing this chart with you is I want to teach you a very important concept that the current price that right now the stock is trading at has probably discounted a lot of future earnings. Let me explain this to you with some data. For example, in the next few years, what is likely to happen? So KNS Technology in August 2024 signed a MOU, Memorandum of Understanding with Karnataka government for setting up a semiconductor assembly and testing facility for 3,750 crores of investment. This was, I think, the fourth company that the cabinet or the government of India approved for semiconductor facility. Now, this is not going to be operational up until FY27. So it is going to take time. So the future earnings that this business may deliver after 27, it's somewhat already reflected in the price of this company's stock. This is what we mean by discounting the future earnings in the current price. Important concept that mutual fund investors, big investors, FIs will do. In fact, if I speak about the FI data, if you note here between September 2023, September 2024, FIs were buying this stock big time, 9.90% to 14.92%. While from the month of June 2024, the Indian market has been under huge pressure. FIs have been continuously selling, but they've been buying this particular stock. Why? Because they are looking at the future earnings. And one of the avenue for future earnings was the semiconductor business that this company is getting into. So one of them is this OSAT facility in the Mysuru. I think it is Mysuru or Mysore. Please, people from Karnataka, let me know. Correct me if I am saying it wrongly. I think it is Mysore or Mysuru. I don't know. I'm confused now. Coming back now, also the second deal that the company did is that they are also setting up a semiconductor fab in Gujarat at a cost of 3,300 crores. So again, the company is going in a big way into setting up semiconductor facilities. Also, if you look at what the company's projections were for FY 2030, company was looking at adding 4,000 crores of revenue coming from the semiconductor business. Right now, how much company is making? It is only making, if I look at their profit and loss account, 1,200 crores is revenue they did. Now they're projecting 4,000 crore by 2030 just from the semiconductor businesses, right? And as per their management, their OSAT business is not going to give them revenues up until Q4 FY26, which is going to be April 2027. Okay, Rahul, this is very long-term sort of a company is what you're telling us. Absolutely. But also have a look at their order book. So if you look at the order book as of Q2 FY25, they had an order book of around 5,422 crores. This is in millions. I have converted that into crores of a strong order book. It's not that the company does not have an order book already going up. And also secondly, by FY25, the company is projecting that they're going to hit a revenue of around 3000 crores. Right now they're only doing 1200 crores, so this is going to be more than double the revenue in FY25 if they're able to hit it. This is where I continue to say to you that this company is enjoying tailwinds, of course, and as a result the future earnings have been discounted in my view in the prices. I may be totally wrong, but if I look at the PE ratio of the company, the PE ratio back in September 2023 used to be around 106. Now in September 2024 the PE ratio has crossed 200 multiples. Now my final point on EMS Technology is that big investors, institutional investors, they are ready to wait for 2030, 2028, 2027. My worry is with retail investors. What they will do is they will end up buying the stock at a very, very high price. And if for whatever reason the stock corrects by, let's say, 10%, 15%, they wouldn't know a lot of details about the company. They will panic. They will do a panic sale. And when that happens, they are going to book losses. This is my humble request to you, is that please understand the game of growth versus valuations. If the valuations are very, very high, because there is likely to be growth, but of course the danger of stocks corrections always remain in such stocks. Therefore, you really need to be cautious with your investment thesis. I've given you a lot of details, but please do not take this as a recommendation. My intent is to bring you insights about these companies, what's happening in the sector, what's the core concept about growth versus valuations. I hope using so far 2 examples, we are very, very clear. Let me now take you to my third example so that the picture becomes very, very clear. And also, if you're liking this video so far, hit the like button. Let's go to stock number 3 now. The third company I want to speak about is PG Electroplast. Have a look at my screen. You will see again very, very similar story or a pattern here, that prior to COVID, before December 2020, the stock was flat, completely flat, no movement at all whatsoever. But after COVID, as the sales started to pick up, I'll show you the numbers in a minute, the stock started to move, and the maximum movement that you will see is between June 2024 to September 2024, again backed by the sales data. Again, have a look at the sales data here. It's very, very similar pattern that we saw in the Dixon Technologies, that prior to 2020, prior to COVID, the growth was very, very nominal, very, very reasonable, or very, very 15 to 20% sort of a growth. But after COVID, if you see, the growth has been humongous. In fact, towards the 23-24 year, the growth has been very, very high in the sales, is what we can see here. Now, PG Electroplast is very, very different company from EMS Technology, but it is very similar to Dixon Technologies because it manufactures products. So for example, if you look at their total revenues in FY24, 60% of their revenues came from products. So for example, ACs, washing machines, air coolers, right? So very sort of a traditional business that they're producing products. 25% of revenues came from plastic moldings and others, which are used in various applications such as automotive, etc. 13% is electronics, which is televisions and PCB assembly. PCB assemblies is an important terminology that you need to know, which is printed circuit boards. A lot of EMS companies who are getting into PCB are going to get benefited because there is a subsidiary, there is a PLI given by Indian government on PCBs. This is a very, very important module that the companies are manufacturing at scale. So therefore, I just thought I'll speak about that. But overall, if you see, their growth has been driven by the product business. You can see the brown bars, how they've grown up, mainly because of AC units. So if I show you some data about AC units, you will see that as of Q2 FY25, 212% of growth, year-on-year growth in terms of the sales of AC is what the company achieved. If you look at the washing machines, only 23%. Air coolers as well, 191% of the growth is what the company saw. So basically, the company is dependent on their product business. The product business grows, their company is enjoying tailwind. Why the product business is going? Again, going back to the same point here, Make in India goal. Indian government has been providing PLIs as part of their 300 billion electronics manufacturing target of 2026. How much of PLI this company has got? In Q2 of FY25, the company got 30 crores of PLI from government. And that's where the production is going up because the company is getting PLI. And this PLI for PG Electroplast is going to last up until March 2027. So it is going to continue to enjoy that PLI approved status given by the government. Another important thing that we need to know about PG Electroplast is that very, very recently they did a QIP, which is qualified institutional placement, where they diluted their stakes, the equity, and gave it to qualified institutions at a price of around 700 per share. And you can see that getting reflected in the shareholding pattern. If you go and see between between September 2024 to December 2024, DI stakes have gone up from 9.80% to almost 14%. And also from a FI's perspective, you see continuous buying has happened in the last 2 years, mainly because of the tailwinds that the company is enjoying. This is where the sector analysis, the thematic analysis is extremely important. If you understand where the sectoral demand is coming from, then you are likely to pick better investment decisions. I share a lot of that analysis on my YouTube member community. If you are not yet a member, consider subscribing. You are going to learn a lot. You are going to get a lot of insights from my exclusive post that I post almost on a daily basis. The feedback has been excellent. Now coming back to PG Electroplast, what they are projecting is that FY25 they are likely to do 4,850 crores of revenues. That is going to be around 77% higher growth as compared to FY24. A lot of this growth and forecast is factored it into the current price. Please understand this. This is a very, very important concept that future earnings have been discounted into the current pricing. That is why if I speak about the PE ratio of this company, you will note that it used to trade at around 40 PE back in 2023. Right now the PE is crossed almost 80, mainly because a lot of future earnings has been discounted. So I hope you're understanding the growth versus valuation conundrum here, that there is a growth here, but the valuations are also very, very high because they have discounted the future earnings. Now, let me know in the comments what's your view on EMS companies that I've discussed. Let me know in the comments. Also, if you would like me to create part 2 of this video, happy to do that. Let me know. It really depends on your likes and comments and the response I get on this video. I might cover a few more important metrics, parameters about the EMS sector, and also might give you insights about few other companies operating in this high growth sector. If you like this video, hit the like button. Let me know in the comments a simple thank you. It definitely motivates me to come up with more content for you at zero cost. With that, I'll see you in my next video. Until then, keep rocking.